Welcome to the Titans of Industry Show. Glad you can join us today. Thank you for carving time and being with us because this will be a very good interview. My guest today, in my opinion, has one of the best reputations in the business for stellar writing, for in-depth research, and for integrity. And before the interview, we spent like an hour just speaking right now. A ton of information from this guy. I read his articles, each and every one of them, and think about them deeply. Steve Angelo is of course, the founder of the SRSRocco report, a must-read site, and I'm happy to have him on the call because we'll get some top-notch ideas today. Steve, how are you?
Great, Lior. And today you go back 10 years ago, and things that changed quickly was rare. It happened once a year. Now it seems like we see things happening every day, so there's a lot to talk about.
Sure. Okay, well, let's start with, on the screen, what the listeners are looking at right now is a chart of the EPU in relations to the VIX. And, you wrote a very good article about the decoupling of the EPU and the VIX after, for 20 years they followed each other closely, and I get the reason why they followed each other closely. And you're talking about something very important, which is that it looks like fear bubbled in 2011, and now we're in sort of a fear anti-bubble stage. Nothing scares away buyers anymore. Do you think investors are confused with information overload? Why do you think this is happening? Can you explain more what the EPU is and what the VIX is?
Yeah, the VIX basically is a VIX index, and when the VIX volatility, which is, and in this chart, it's based on the S&P. So when there's a lot of fear and when there's a lot of trading and it's very volatile, the VIX index spikes high. Well, when the people feel good, things are doing well, trading is more relaxed and calm, then the VIX index tends to trend lower. And actually, one of my bottom charts, the VIX bottomed like right in 2007, where we're at the same level when the VIX bottomed in 2007 before all hell broke loose. But in this chart, the analyst who put this together, he found a very interesting thing. There's two different things there. We have the VIX index, which is in the black line that shows the volatility of the S&P. And then we have the blue line, which is the actual EPU index, which is called the economic policy uncertainty. And all that means is that it's an indicator of how many articles on the mainstream media that talk about the economy, uncertainty, the Federal Reserve, regulation, whatever. So normally when the VIX index is moving up and there's volatility, there's a lot more fear and uncertainty on the mainstream media. And so this correlated pretty good in this chart from 96 to about 2011, at the end of 2011, in the beginning of 2012. Well, what's interesting is that's when the gold price, it peaked. But after 2011 going into 2012, we see a kind of a disconnect. And that's exactly what this chart is showing us. The volatility continues lower, which means the market thinks everything's fine. But the economic activity, the economic news, the uncertainty in the market is it's been trending at all-time highs. So this analyst basically is saying that the market has been lulled to sleep. And this could be a bad situation going forward because people they're not prepared. And what the most important thing is, asset prices do not reflect the realistic. They're very high risk, and because the volatility index should be high, which means high risk. So they have underpriced the risk in these assets. That's what that chart is telling us.
Well, and what I like about the chart is you can actually see it decoupling in the .com era as well, like 98 to 2000. Looks like it's decoupling there. And what I also love about this is the fact that 2011 we had the Greece Greece default and the fiscal cliff, and it looks like once we went over that hurdle, then people said, okay, well, what else can happen? And they start to come in and buy stocks again. I mean, 4 years have gone by, or 3.5 years at that point from the crisis, and to me, it looks like the mainstream America had bought into the fact that Bernanke was the man of the year on Time magazine, and the government is in good shape. It looks like for most of Americans, it's back to normal. Do you think that this is the predominant idea right now within mainstream America? You got like 100 million investors in the stock market in America, maybe even more. Do you think most of them right now are not looking at the PE ratio of the S&P 500 and saying, I gotta stay away? They're saying, hey, there's no alternative. Bonds are lousy. Cash is eroding. Real estate is expensive. It's more expensive than before the bubble burst. I should just keep on buying my favorite stocks.
I agree. You talk to people on the street. It's kind of like it's a knee-jerk reaction. It's the public is very fickle, and unfortunately, not only the public but a lot of the funds are, and so. And the thing is, there used to be more of active in fund investing. Now it's more passive fund investing, and so they realize that they're not going to fight the Fed. So what we're seeing is yes. People have, because we have to remember, it wasn't really since 2011 that the central banks really started amping up their central bank purchases. They were before, but then we had QE3 from the Fed at the end of 2012, and then after that, then we started having the European Union and then the Japanese. And it was kind of like one left off and then the other started in. So then we had this huge central bank purchases. So that's the reason why also, if we didn't have those central bank purchases to prop things up in the last 6-7 years, I think the volatility index, because it's propping up the markets, and now we know that they're buying stocks too. So I think the issue is yes. I think the VIX Index falling lower and then the central banks propping up the market. What we know about it's got to be much higher with what they're doing to intervene in the markets. There's much more money or funds moving in that are propping the markets up. So with that, yes, it you know what it's done? It's taken the emergency warning lights off of your car. You're going down the road, and your engine's burning up, and you've got no brakes. So what's going to happen? Your engine's going to blow up and kill you, or you're going to go over the cliff. But you don't know that because the warning lights have been disabled. So this is exactly the market we're in right now, and that's because of central bank intervention.
So basically, they're distorting the edge or the gut feeling that investors have or should have when the data is so clear in one way.
Yeah, absolutely. The PE ratios, a lot of these, the S&P. I mean, God, look at the Nasdaq, and then the Dow Jones. They're not. They've been higher before, especially during the tech boom. But I think it was an interesting article by Wolf Richter on Wall Street. He just did a great article showing that the earnings of the Dow Jones over the last 3-4 years hasn't been, the earnings growth the last 5 years hasn't been that much, a couple percent. But the Dow Jones is up 80%. That doesn't make any sense. It only makes, so what we have right now is we have asset inflation and inflated GDP. And it's all being propped up through central banks. And so, yeah, everyone, why fight that? It works until it doesn't, just like in 2008. But I'll stop.
Let's talk about the ramifications of this, because, when they create new currency units, when they intervene in the bond market, when they create this false demand for dollars, because all it is the entire world is working under a fiat payment system. It's a payment system. It's how you transact with these digital fiat currencies between everyone in the world. That's how the commerce works. Obviously, people that say abolish the Fed and all these radical solutions. Well, what will replace the Fed? The Fed is and all the commercial banks are a payment system, and we don't have an alternative payment system right now. And so they have to keep the game going. Otherwise, it's going to be very, very hurtful for people who just own a lot of savings. Their payment system, the way that they save, is going to be wiped out. And so what I want to ask you is, when they create all of these units within their system and spread it around to the commercial banks for ultra low interest rates, where is the ramification of this? When are we going to get the tax bill? When are we going to get the other side of creating new currency units when there was no real demand for them? It didn't go into productive economy, it went into the top echelons of society and never reached Main Street.
That's a good question. I think we're seeing it right now in Illinois because there's the pension and the whole state system is a complete disaster. And a lot of the Northeast is that way because it's one of the first parts of the country that were settled first, and then you had all the massive infrastructure, and then all the people are retired, and so that costs a lot of money to maintain that, just to maintain it. So Illinois, I think from what I heard, they're getting ready to raise their taxes 35%. So we're starting to see that right now. But I think that, you ask him, when is all this, where's the tax bill? I think that you see, again, like I mentioned, in 2009, everything went in, all the inflation, all the money printing, all that went into everything. Gold, silver, energy, copper, precious metals, like I said, and into stocks, bonds, and real estate. It all went up. But then something happened in 2012, and then precious metals fell first, then the commodities and energy fell in 2014. But the markets and the real estate and continue higher. They just continue. There's a huge disconnect. So I think that's where, you see, it used to be hyperinflation when you print all the money. You've got a wheelbarrow to buy a loaf of bread. Of money. Well, no, what's happened is we don't have that. Instead, what we have is it's asset inflation, and that's where a lot of this went to. And so, and the important thing to understand about that, and you need a viable energy system to allow all this to function. And when the energy system gets in trouble, and it is, and I'll conclude by saying this: in 2008, we had a lot of trouble. We had trouble with the subprime housing market in the U.S. We had big trouble with the investment banking industry, which is no longer here. Lehman Brothers is gone, been around since the Civil War. We had Bear Stearns, they're gone, and Merrill Lynch, they became part of someone else. So now all we have is the commercial banks. So we had the huge home housing market collapse. We had the investment banking collapse. We had an overall disintegration of the markets. What we didn't have was a collapse or disintegration of the energy market. The oil and gas producers were doing really good in 2008, even in 2009. Unfortunately, now, fast forward to 2016, 17, they're in big trouble too. So now we have bubbles everywhere. But the underlying thing that runs everything, you can't switch on a light without electricity, you can't get in your car without gasoline, and the farmer is not going to produce corn without diesel on his tractor. All that is based on the energy. Now that is in big trouble. And that is what is basically running or holding together all these highly inflated stocks, bonds, and real estate. So I think the issue is the energy is the key, Lior, and I think it won't be taxes per se. I'm not saying it couldn't be. We will see increases in taxes. Taxes will increase to make up for shortfalls in government and other things. But I think the real the real thing that's going to take the system down is the energy. And so that's how I see it going forward.
Well, Kissinger always said that with oil you control nations and with food you control people. So let's talk about this great U.S. energy debt wall, and it's a global debt wall for the energy prices. You're saying it's going to get very ugly. Can you lay out what you're seeing, the picture, the roadmap kind of what will happen in the energy sector, the oil sector, that people are missing? People are looking at the data, but they're missing the point. And what is the point?
Okay, in a nutshell, the world grew on conventional oil. That's the cheap to produce. It has a high energy return on investment, and it allows for a lot of economic growth. And we survived on that for 100 years. Well, that kind of peaked. And to give you a perfect example, we consumed 25 billion barrels of conventional crude oil last year. We only replaced 2.4 billion. So we replaced less than 10. Now we're making up with it with the shale oil, with the tar sands, and the problem is people think this is a viable alternative. Well, we'll just bring on shale and tar sands and deep water and all this stuff. Unfortunately, no one made any money doing it. That was the issue. And I've seen data and charts that since shale came in the picture, they spent more money on producing it than they got in their operating cash, and that started in 2009. So when you look at the top producers in the U.S., and you add them all together, they went into the red in 2009, and they got worse by 2016. And so now they didn't make any money. So what would happen? They increased all this debt. So before the energy industry could produce the oil and make a profit and continue, find more oil and wash and repeat. Now the shale oil industry that is supposedly going to save us has been a giant, I call it a Ponzi scheme. So now this is the problem we're facing. There's a debt wall, like you mentioned. So they didn't make the money. What they did is they borrowed the money. They borrowed it from pension plans. They borrowed it from funds, even an insurance company. And so now there's this huge amount of bonds that are due over the next 5 years. This is the problem, and that they're paying a lot of interest expense on that. That's another big problem. The interest expense there has ballooned, and they have to cover it every month, every year.
Now, is this just U.S. oil, or is this a global problem?
This is a global problem, and I mentioned during our pre-interview that the global oil and gas industry held $1 trillion in debt in 2006. Now it's over $3 trillion. And we really haven't brought on a lot more oil. We have
issued debt, but they really haven't made it up in production. So basically, they're in a worse situation than they were 7 years ago. And now with Europe coming and becoming stronger and healthier, and with China so weak, it seems to me that what you're saying is when China resumes, more stability, their PMI starts rising, they're going to need that energy, and it's not going to be there unless they will issue more debt. And who will pay for that debt? This is not a government. These are companies that want to issue more debt, and they're indebted already.
And that's correct. And to give you a perfect example, Continental Resources was the larger players in the back end. They paid $13 million in the interest expense in 2007. Last year, they paid $350 million. They didn't pay any debt down. That's like if you got credit card payment and you can't pay, you don't have enough money to pay down your credit card. But what does the credit card company want you to do? You've got to pay a minimum interest payment. Continental is paying $350 million a year now just for the interest expense. So if you look at this, not only U.S., it's happening globally. Saudi Arabia is liquidating their foreign exchange reserves. They continue to fall because they're not making enough money with their oil. Pemex, the Mexican oil company, is technically bankrupt. And let me finish by saying this. Venezuela right now supposedly has the most oil reserves on the planet. They do. They have more than Saudi Arabia. And then they're down to eating dogs now. The reason why that doesn't work is because they have heavy oil. It's not really commercially viable. If they had light sweet crude like Saudi Arabia did, they would not be in the predicament even with let's say a socialist government. They would not be in the predicament they are today if they had very cheap quality to produce oil but it's very heavy oil. So this is the issue they're at right now. And so that's just another factor showing you it's a global issue. It's just not the U.S.
Okay. Well, let's talk about the correlation between oil and precious metals. If oil is that important to the production of precious metals, and obviously it is, you need it for every aspect of mining, lower oil prices are basically bad for gold and silver prices.
And that's correct. We can go back and look in the 70s when gold and silver really surged. I think in the 8-10 year period from 71 to 1980, gold went up 14 times, silver went up 15 times, oil went up 15 times. So we see a pretty good correlation. If we looked at this last, since 2000 up till 2011, oil price was like $20, $19, and it went up over 100. Well, gold and silver did the same thing, and they went up with the oil inflation. So it's true. The issue that I talk about, that's basing gold and silver like a commodity based upon its what it costs to produce it. But you see, gold and silver is a store of value. It's a store of like economic energy. And so it differs from an asset like, let's say, a retirement account or a stock. And so a stock gets its value from net present value from what happens in the future, economic activity in the future. Well, if energy becomes problematic, so does the valuations of stocks, bonds, and real estate, which is why I see gold and silver disconnecting from what their cost of production is to more of their store of value. And you don't need a lot of money moving into gold and silver when there's like 330 trillion of assets, stocks, bonds, and real estate. You don't need much to go in there when people start to realize that these other assets are going to become problematic and their values are going to fall because the energy that runs everything is starting to fall apart. So that's kind of how I look at why gold and silver will move up 3, 4, 5, 10 times above their cost of production. I see that in the future.
Okay, well, let's simplify what you said because I want to make sure that we got this correctly. Most of the time, in regular times, a commodity would be priced somewhere above, but reasonably above, marginally above its cost of production. So for silver, about $15, $17, the average industry cost production, it would be somewhere in that neighborhood above that, so companies can turn a nice profit and pay salaries and pay the shareholders. For gold, it's about 1100, so it will be trading above that, somewhere above that. But they have this markup, this added value, that they don't have just the utility for silver. Its industrial demand is thousands and thousands of product that it helps to produce. And for gold, jewelry and some electronic catalysts that use it. Now you're talking, hey, this is a store of value, and now it's much more valuable to me to hold it than just as a piece of jewelry or as an industrial component for my product. Now I want it because it can save my retirement, it can save my assets that are not inflation hedges from falling down, etc. Then you see it going 5-10 times the production cost, which is for silver that's like $150 in today's dollars. Do you see it going that high? And is the reason you see it going that high is because the stock and bond universe is so much larger than the precious metals universe?
Yes, and it's hard to get your mind wrapped around this because you have to go to the root, which is the energy. If you don't go to the energy and understand the energy, this doesn't really make sense. For example, I listened to the recent interview with Harry Markopolos on King World News, and he talked about, he was the whistleblower for the Bernie Madoff $65 billion Ponzi scheme. Now, if you were in Bernie Madoff's fund for, let's say, 5-10 years, you were doing pretty darn good, making lots of returns. You were doing good. Everything looked great. Until one day it didn't. Now, and so that's how I look at the stock, bond, and real estate market. All of them. They all look great right now. And but it's really not based upon anything. It doesn't matter if you get $1 million of digital wealth in your account. You need to burn that energy to produce the economic activity to repay that $1 million of digital assets. There's not $1 million worth of gold in that bank account to sell the gold to give you your $1 million. You need to burn the energy. So that's how, and let me just say this again. Let me just say this. Harry Markopolis says that he now sees the whole system as a Ponzi scheme. So, and he's a pretty smart guy. So I kind of agree with him on that. So that's the reason why I look at the gold. You see, the value of gold and silver has always been there, but unfortunately, the market has been brainwashed like Bernie Madoff did to his investors, but they don't know it. So they say, well, the price of silver, it rose because people moved into it. The price of gold and silver should have been up much higher if everybody understood what was going on with energy, with this whole bubble market. It should be up much higher right now. The reason why it's not is because the whole world has been bamboozled into believing the Bernie Madoff Ponzi scheme. It's just not a small group of people. It's the entire world. And so, and this is, it's huge. So that's how I see it unfolding. And again, if you just get 1% of the 300 trillion or plus, whatever it is, 3 trillion, the global investable gold and silver, Leonora, is worth 3.1 trillion. That's all it is. All the gold and silver that you can get your hands on, central bank, private and public, silver and gold that you can get your hands on, it's worth about 3.1 trillion. If you just got 1% of the assets moving in there because they're starting to worry about things, just 1% would make the value of gold and silver go crazy. I can't imagine any higher than that.
Well, and just to kind of back what you're saying up, 1% is nothing. Historically, people have owned much more than 1% in their portfolio as holdings of gold and silver. It's just in the last 20, 30 years that it's gone down to, I think it's 0.58% right now of people owning gold and silver, like one in every 200 people, and I bet those numbers are high just because of Asia. I don't presume that in the U.S. 1 in every 200 own gold and silver, and in North America or Europe as well. And so yeah, it's easy to see that happening because it's not that much. It doesn't require that much people. And I want to ask you regarding this, what do you think of the appetite of Asia for gold and silver? And when you look at the data, do you think that Asian buyers are looking at silver the same way as they're looking at gold, as a precious metal, or are they more into gold?
The Asians, and we could include Indians. It's middle, it's Asia. But let's say the Chinese, the Asians. The Asians favor more gold as an investment and a store of value. They favor gold. And it seems like the West, up until Trump got elected, the West, which is Canada, the United States, in Europe and maybe Australia, they favored more silver. Actually, there was more silver as in ounces, as in buying. And so what's happened now is that, I'll tell you an interesting thing. In May, the Indian silver imports were almost 1,500 tons. I mean, that's a big number. It's one of the largest monthly imports of silver. They've fallen off considerably in the last 6-8 months in India. And to see that they imported that much silver in 1 month means to me something's changed with the Indians. And Indians tend to purchase silver more of a speculation. They do. It's an investment, but it's more traded. Where in gold in India, they buy more gold as for jewelry for their investment. And Asia is the same way. In China, they purchase gold more as an investment. But I do see silver. There's a big percentage that is industrial. But going forward, I do see silver will outperform gold, and it doesn't matter how much industrial silver demand was going to be, because I have said industrial silver demand will continue to fall, and it has. It peaked like 5 years ago, and it will continue to fall. It's not going to be the indicator of silver price going forward. So again, I think the West has been buying more silver as an investment in ounces than gold. In Asia and India and China buy more gold as an investment.
Steve, how much reserves do we have of silver right now? I mean, the price right now is about $15 per ounce, 15.67, depending on which day you're looking at this interview. With this much demand, and the demand is more than the supply right now on a global basis, how many years of reserves does the silver industry have?
Gosh, I knew that number. I think at one time it was I think it was 16 months. Now it's up to 30 months. No, it isn't. And actually, I'll tell you, I mentioned the number. Let me tell you, according to 3 different sources, the best we can go by, there is about 2.2 billion ounces of gold that you can get your hands on. That's all the gold. And then there's only 2.6 billion ounces of silver. So when you look at that, because there's much more central bank gold, there's not, central banks don't have much silver, and the silver that they did have, which was Russia, India, and China, they sold a lot of that into the market in the late 90s and early 2000s. Sold a lot of silver into the market. You know what's fascinating? The Asian Eastern countries were selling silver, and now the Asian and Eastern countries are buying gold. But there isn't much more silver than there's gold. So when funds start to move into the available physical silver and gold, the silver value will increase a lot more because there's just a lot less of it there. I mean, there's not 10 times more silver as being mined. There's only a small percentage more of available silver. So that's how I see that in the future.
Okay. Well, last 2 questions, Steve. Let's talk about what's going on with the Dow Jones, the S&P 500, etc. They're breaking all-time records. The P ratios are very, very high, even higher than the 20-year average. So, the classic average is like it was around 15 forever. The P ratios for the large cap companies. Since the 90s, it's around 19.5. Even if you change your mind and said, look, this is the new paradigm, I'm going to buy companies that are priced around 19.5. I'm not going to wait for 15 anymore, because you might not see those ratios coming back for a long time. The S&P 500 is trading at a 25 times multiple. This is very, very high, but there's no indication that the bull market is ended. There's no blow off top. There's no rush. People still have a large cash allocation. Many people have not participated in the bull market so far. And so do you think that commodities are now inversely correlated with the large indices? In other words, so long as the bull market is running full throttle, do you think there's a chance that commodities will lit up as well? They're obviously cheap. They're obviously hated, ignored. Goldman Sachs even said they're considering now shutting down the commodities desk. And I'm talking Goldman Sachs. This Lloyd Blankfein, the CEO, came up in the commodities desk. So we are seeing large firms throwing in the towel. What do you think of the correlation between these 2 asset classes?
Well, the funny thing is, you can't produce an Apple iPad without commodities. And so it's worthless. I don't care how many profits you make with Apple. I don't care, how many profits you don't make with Tesla. You can't make... Yeah, you can't make anything without the commodities, and it is interesting. If you go back to the Depression in the 30s and 20s and all the different recessions, you kind of see a correlation. Not always, but the price of silver really fell, as well as oil during the Depression in the 30s. So is the stock market. Same thing happened in 2007 and 8. But this time, since 2011, 2012, it's been like a big disconnect. And now that works for a while because, it's like a train. A big train takes a while to stop. So it takes a while to stop. Now, yeah, we can continue to see asset prices continuing to inflate. We can see the Dow Jones move up. But you know what? I think the problem is you're starting to see actual economic indicators that are stalling. We're starting to see what they call Carmageddon. They've done everything to keep people buying cars. Well, that's an important indicator. I know I've got family. They went to Las Vegas. They checked out one of the casinos and the hotels. One of the hotels has rented out 2 or 3 floors of their parking garage. It's all full of vehicles, brand new vehicles, because they can't put them anywhere. And I also hear a lot of these malls that now aren't doing so well, or some of them are vacant. They're renting out their parking lot to put these new cars because they can't put them at the car dealers because they're full. So when you start looking at that, you see these economic indicators are starting to top. Well, I don't know how much longer those economic indicators can top and fall before it impacts the indexes, the stock market, the Nasdaq, and the S&P. So even though there is this disconnect, and if commodities keep staying low, especially energy, it is going to kind of gut the system, and it will pull down the economy with it. While we've had this disconnect and we've had these high inflated prices, it's not something that's sustainable. It's happened for the last 6-7 years. I don't see it for 6-7 more. Could it be for a year or two? It could be. Could it be for less? It could be. But let me conclude by saying this. I don't see commodity prices really taking off. I think we're going to see trending lower. I do. Copper prices, when the markets really crack, there's going to be a glut of copper. You're not going to need copper. And when the energy markets start to fall apart, there's going to be less energy produced. So there's going to be less economic activity. So the actual commodities, which is number one, is energy, it's going to pull the system down with it. So that's how I see it. It may take a little while, but the more we go, the more weeks and months and a year or two we go, the worse it'll just get. So that's how I see it.
Let's talk about, Leslie, about cryptocurrencies. I mean, the technology beyond them is absolutely brilliant, but obviously very early in terms of mass adoption. And my question to you is, how will governments tackle this competing payment system? Is the world even ready for less centralization? I mean, you, me, our listeners here, we're free market enthusiasts, but most people, they need a chaperone, they need a nanny. If you're going to tell them that their money is not insured, that if something happened, they wouldn't get their money back, if they got hacked, all these risks that we as free market enthusiasts, we take on as natural and normal. Things have risks attached to them, but they want that zero risk. They want less freedom, more security. If something happens to my pension fund, I want to know that you're going to cover me. And do you even think the world is ready to adopt a decentralized system where it's really truly perfect capitalism?
That's a good question, and to be honest, I don't have a good answer. But I will answer it this way. The one thing the cryptocurrencies don't have, they have a lot of problems. Gosh, we could talk all day about their problems. One thing they don't have is trillions and trillions of debt backing them up. I don't care what currency you look at, even though U.S. dollar is the reserve currency. You can look at all the euro, Japanese yen, yuan. They got debt up to their eyeballs. So, yeah, that's right. It's so. When someone says, that look, I've got money in my pocket. No, you've got an obligation. That's an obligation. That's a debt you owe someone. Using it to pay, to pay for your gasoline or food, whatever. But it's not really money. It's an obligation. Well, you see, that's the one thing that cryptocurrencies don't have. They don't have all this massive debt. Now, I don't really know how things are going to play out. It does make sense to me that, of course, a government is not going to allow something like the Bitcoin or the Ethereum to flourish if it gets too big, because now I think it's fallen considerably in the last few days, a week, but it's still small. But if it does start to get big, yeah, I do see there's probably regulation, but I look at this market that I don't see business as usual happening for 10, 15, 20 years. Since the crash of 2008, the housing and banking industry, it's been 9 years already. It's been 9 years. I think 9 more, we're going to be in a whole different world, and that's because of the disintegrating energy industry. We're going to be a whole different world. Now, maybe cryptocurrencies will perform other functions, because you have to remember this too. A federal government only can survive on energy, cheap energy. People don't realize that. Walmart's, all these big corporations, all these big companies, they need cheap energy. So
it's cheap energy as well. It creates all this discretionary income.
That's exactly right. So when energy becomes a problem, well, guess what? So do big corporations. So do big box stores like Best Buy and Walmart, and we're starting to see that already. We're starting to see it already, and so this does not. Federal governments aren't immune to that. So cheap energy allowed the U.S. Country to be formed, and it allowed the federal government to flourish. But now I'm not saying expensive energy, but a falling energy or expensive, or let's say a falling energy return on investment, which means there's less quality oil available. It continues to fall. The U.S. government needs a high energy return on investment to function. It can't function on a low, and this is exactly what happened with the Roman Empire. The Roman Empire's falling energy return on investment was the main factor that took it down. That was it. And it's the same factor that's taking down the U.S. empire, if you want to call it that, or the U.S. economy. And so it's also going to impact the federal government. So I think in time, I don't know how this unravels, but I do think we may see cryptocurrencies performing certain functions that we just don't understand, that may be better than we think about. But again, regulations probably are coming, but my gut reaction is I think we're going to see a lot more money move into the cryptocurrencies, whether we like it or not.
Interesting. Steve, tell people a little bit about what they can find on your website and all the good stuff.
Thanks, Lior. I have the SRSRocco report site. You're more than welcome to come check it out. We put out 2 or 3 articles a week on energy, the mining industry, the precious metals, and how the falling energy return on investment impacts the overall economy and everything else, which it does. And I've got some reports there, so your followers and readers are more than welcome to check it out. And I think we try to put out original content as much as possible that you really can't find anywhere else on the internet.
Steve Angelo, thank you very much for taking the time today. You really are a great guest.
Thank you very much, and hopefully we can do it again sometime.
Sure will. Thanks, man.